Hey everybody, this is Advisory and I'm Diana Tung.
I'm Stephen Morris.
This one's for the real estate investors out there. Here at Advisory, we love taking advantage of depreciation. But unfortunately, there are some limitations on how much depreciation you can take. So today we're going to talk about how short-term rentals can kind of get you there.
Okay, so we get this question a lot. Hey, I want to use depreciation to lower my taxable income because I don't want to pay anything to the IRS. And I love that goal. You love that goal. But unfortunately, it's not available to everybody. Let's just talk very briefly about what it takes to be able to use depreciation against your income. We have an article below as well that talks in more detail about the mechanics and the code and all that, but I'm going to give you a very high-level overview as to how it works. So normally under the code, all real estate is considered to be passive. And we have this pesky little area called passive activity rules, which under code section 469 limit the ability of a taxpayer to be able to take passive losses against their income unless they have other types of passive income. Now you might be thinking, well, then what we can do is turn this into ordinary losses. And you might have heard of this area called the real estate professional, which is under code section 469C7. Unfortunately, to be able to qualify for this type of real estate professional designation and take those juicy depreciation losses against your full-time job where you're earning really big bucks as a W-2 earner, you have to have a certain hour threshold test. And to quickly review what that is, we're talking about 750 hours a year in real estate trades or businesses, which doesn't seem problematic by itself, but there's also an additional modifier. There's an and modifier to that. More than half of your time during the year must be in those real estate trades and businesses. What does that mean in essence? If you're working a full-time job, assuming 40 hours a week and 52 weeks a year, that's 2,080 hours. You would have to work well over 4,000 hours a year, 2,000 towards your job, and over 2,000 hours towards your real estate in order to qualify. That's not reasonable. You'd have to be working 80 hours a week throughout the entire year. Very few people have that type of superhuman capability to do that. And so generally speaking, when you're trying to take these depreciation losses from your normal passive rentals against your active W-2 income at your high earning job, the IRS can look at it and go, sorry, we don't believe you. You probably took a little bit of time off in between. You're probably not going to meet this hour threshold. Are we totally just out of luck? Is there no other opportunity for us to be able to take depreciation from real estate holdings against our W-2 income? I don't know. What do you think?
Well, I'm sure you've probably oftentimes heard of this thing called a short-term rental hack, right? Everybody's trying to take advantage of this hack, and Airbnbs is the best example of this, right? And so when you have a rental property, it's considered passive income or loss. But typically, if you have a short-term rental, which is less than 30 days, then you're kind of actively participating and you're actively renting this rental out. And so instead of kind of putting this on your Schedule E, which would be typically a passive rental activity, you get to put it on your Schedule C, and it turns into ordinary income or loss on your tax return for the taxpayer.
Yeah, and that's an important distinction because while we're both viewing this operation as real estate, actually in the code, it rises to a different level. It looks more like a regular ordinary trade or business. And generally speaking, it falls under the hotel kind of category. Hotels they're certainly not passive, as we all know. It's not like you let the guests check in and your obligations are done. Of course, you've got to provide housekeeping, you've got to provide services, you've got to be able to respond to the guests' needs, and you might even provide food services, tour guides.
Amenities.
Amenities,
right?
all sorts of amenities. These type of things you're just never or hardly ever going to see in a typical apartment rental, for example. And that's the distinction. It's going to be how much services you are providing in this activity that allow it to move out of this real estate bucket into a
ordinary trader business,
which is what we love, right? So we're all about that here. This is a huge, I don't know if you want to call it loophole. I'd argue actually in some ways, maybe it's not quite a loophole because you still have to work, right? I mean, I don't know anybody who's an active Airbnb operator who just goes out there and the property just sort of runs itself. I mean, you've got to respond to the tenant's needs. You got to be there at all sorts of hours to be able to deal with emergencies. What if the water isn't working? What if the power isn't working? What if
got to schedule the cleaning?
Oh yeah.
Right.
So that's a pretty darn good strategy. And so when they buy this Airbnb property, what's the typical tax outcome? What does that look like? Are we then able to use bonus depreciation, and how does that work? Are there any limitations?
fantastic that you talked about bonus depreciation, which is something that we love to utilize now. It's something that potentially is kind of sunsetting in the next kind of couple of years, right? Currently for tax year 2024, we're at 60%. It's going to go down to 40 in 2025, and it's set to sunset to nothing after that, right? Unless our lovely government kind of brings it back, which is something that oftentimes comes back on the table.
We're really hoping for that,
Yep.
for sure.
Oftentimes, if you're setting up an Airbnb, you're probably putting in a lot of furniture, right? You're probably setting it all up so it looks nice and cute for next people coming in. And so a lot of that stuff you can kind of take a nice big portion of depreciation on. So those expenses you can expense kind of in that first year, and you get to take those losses against your other ordinary income.
But not to mention the good old-fashioned cost segregation study that we would end up doing on the entire property as well, right? The depreciable life of a home, normally as rental would be 27 and a half years. Now we're talking about 39. And so we have even bigger incentive to be able to do this cost segregation study so we can move a lot of these assets that are things like land improvements and shelving and cabinets and all that out of that 39-year life into something much shorter. So that's where we get a lot of our benefits from as well.
So today we talked about how depreciation can truly lower your tax bill, but is subject to limitations.
For you high-earning W-2 earners out there, there is one little loophole that you can get around it, and that's by the utilization of short-term rentals.
If short-term rentals sound like something that you might be interested in, feel free to reach out to us, and we can help you apply this strategy so that you can start saving on your taxes.
So thank you so much for joining, and we look forward to seeing you in our next video.